Welcome to the Roadmap to Retirement podcast. Ashley Sullivan, thank you for being here.
Thank you for having me. Excited to be here.
Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Yeah, we're going to talk everything about investing in an election year, and then we're going to get into a little bit of just general market updates or things to think about with where we are in the cycle.
Yeah.
But give yourself an introduction. Who are you and why are you here?
I'm here because you invited me to be here. Ashley Sullivan. I'm right up the street at 1865 Wealth Advisors and CFP, similar to Alex, and have advised for over 15 years at this rate. So
Here you are, experienced
here
voice.
I am.
So this is not
Been
your
through
first
many election
Yeah.
cycles. Yes.
How do you
Good,
feel like
bad.
that's changed over we didn't talk about this before, but how's that changed over your course of being in this business, being through, 4 elections or
Roughly, probably.
4 elections since then?
Yeah.
How do you think that the noise around the election has changed, and how does it affect our investments?
Oh, that's a good one. I would say social media, right?
Okay.
That's certainly grown. Like Facebook just was coming out when I was in college. So now if you think about Instagram and Twitter, X, you're just inundated with information, right? And data. Just as we had mentioned, we were talking about statistics on what political party's in office or if Congress is divided. There's just so much data out there and information coming at you and at our clients, obviously, to wade through. I think it's easy to get concerned these days. Headlines, right? They got to grab
Sure.
your attention.
Yeah, there's a lot of that kind of clickbait out there where everybody
Yes.
sees if Trump wins, this is going to happen, or if
Yes.
Harris wins, this is going to happen. And I think that's the major question that you and I probably both experience talking to clients every
Right.
day is people want to know if the person I hate wins, is the world going to end? And if the person that I love or consider to be the lesser evil gets in, is that going to be better for my investments or better for my retirement? So
Right.
to get right at the question, does it matter in your mind?
No. And I love how you had titled it like, does my portfolio care? Your portfolio does not care, right? We were just talking about stats jokingly before this, and it is truly neck and neck if a Democrat or a Republican is president, especially if Congress is divided, right? There's checks and balances. That means one political party is not getting through all their policies. Truly, and that data goes back to 1922. So very long spanning to say it does not matter.
Sure.
I know we internalize it to matter, right? Because we're saying this person wants this to happen and I feel this way strongly. So it's natural. I think a tendency as being human is to want to align with some type of affiliation, a group, but it does not matter for your portfolio.
It's hard you talk about 100 years of history that we're pulling it from, which sounds like a lot. And in some ways that's a pretty good sample size, but also that's only 25 elections. So it's really not, it might not be enough to say that there's a strong trend either way, but
Right.
when we look at the numbers and how they come out, we see it's pretty much neck and neck. And then you consider all the anomalies that happen within an election cycle.
Right.
Recently we had COVID, which was a game changer, right?
Right.
We talked before about Obama administration taking over at the bottom of a recession. So how does that project forward? And if you take over at the rock bottom, you're almost always going to look good on the investment standpoint.
Right.
The same is true for us, right? If a client starts working with us in the middle of a depression, 10 years later, they'll be like, wow, Ashley did a great job with investments. Yeah, Ashley, which I'm sure you would.
Of course.
So it's really hard to sift through the statistics. I think that's something that I found preparing for this
Yes.
episode, to find something that people could truly hold on to is very
Absolutely. Yeah, geopolitical events. And you think about 9/11, and I think it's easy for us to say, oh, but if so-and-so was in office, they did do a great job, or they wouldn't, and that's really not the case. There's so many people during those events on both sides of the political parties that are helping to course correct whatever's happening. So, and yeah, I mean, we've talked, and there's way more things that we consider as the financial professionals when we're helping clients. And that's, is inflation trending upwards or downwards? What's the Fed doing? It's been huge. That's been in the news for several years, right? What does earnings look like? Earnings growth. Those are things that I think if you follow those trends, they're going to be far more impactful than the political.
And those are real things. Like
Correct.
It's almost in the political world, you have to separate the policy from all the noise that goes into it.
Right.
So 99% of what you see when you turn on whichever news organization you feel is not biased,
Right.
you're seeing just the noise around it. But if you break it down to what are the actual policies, what are the procedures that are going in place, and
Right.
how does that affect my portfolio? And then there's the things that our politicians can control policy-wise,
Right.
and there's the things that we really can't. Which,
Right.
as much as you want to think that we can control inflation, there's a certain element to it that's always going to be a mystery. So you're at the mercy of what happens there.
And I think you bring up a good point there, though, is with policy. I think historically, you can try to gauge which political party is going to head some direction with a policy. And then there might be more like micro investing themes, more on a secular level that you could invest in. But again, policies don't ever translate to great investment outcomes.
Yeah, I think you can look at, like you said, the different sectors within a broader economy, within the stock market. And you could say, for example, if Canada X wins, that might be good for renewable energy sources.
Right.
So investing in companies that are into that might be good. So there are opportunities there, but
Yeah, certainly.
let's say that the election itself doesn't matter from an investment standpoint.
Right.
What are some things that do matter in today's economy? I know we can talk about interest rate and some other things, but what are maybe the top 3 things that you think investors should be aware of or considering?
Yeah, I mean, I would definitely say what the Fed's doing. We went into this year thinking we were going to have all these rate cuts, and then that hasn't happened really until towards the end of the year. So I think that's huge. That's really important. Inflation has been another hot button topic that we've been watching for several years as it's coming down slowly.
Mhm.
And earnings growth, just like, are companies healthy? Are they doing well? Another thing we've seen the past several years is the FANG stocks, then the Mag 7. And it's really very like a narrow breadth of companies that are helping the market do so well. So that's something really
Sure.
to consider.
Yeah, I think to summarize that, so if you look at the S&P 500, there's only a handful of companies at the top of that list that are driving the returns. When
Right.
you have a year with positive return, it doesn't mean all 505 companies or whatever
Right.
it is are up. It means that there's a small portion that are dragging
Doing
the
exceedingly
index up.
well. Yep.
So it's
And how much they've grown too. As you had mentioned, COVID, how much some of those tech companies or AI type companies have grown post COVID, that their market cap's huge now in the weighting in the S&P. So that's also something that's changed in the past several years.
yeah, it's one of my favorite things, and this is definitely a segue away from our topic. But when people casually mention like, how's the market doing, or the market's doing this, and it's
Right.
first of all, which market are we talking about? The S&P, the Dow Jones? Like there's
Lots of markets.
There's a lot of markets. There's so many different indexes out there. So let's start with what are we actually having a conversation about?
Right.
Then even within that, is the market doing well, or are 10 companies doing well
Right.
and the market is neutral or not really doing well? So
Right.
it's a different conversation. That's not why we're here. So let's
Right.
go back. Another policy thing that a lot of people are asking us about right now is what happens with the Tax Cuts Act.
Right.
So we've got a year and change before the current tax code is essentially pushed to the side. My feelings are that something will change, that no matter
Right.
who wins the election, there'll probably be somebody that's there to save the day and make themselves look good. Not to
Right.
sound totally cynical, but
Right.
where do you think that goes?
Yeah, I mean, there's so many pieces to that act. So that's something kind of, again, a plug to work with a financial professional. So you're not having to wade through that whole act and be like, what stays, what goes,
Mhm.
because there are certain pieces of the act that are not set to expire, right?
Sure.
So some things were put in like permanently. But there's going to be, and it's so individualized, right? But one of the things, of course, for corporations is that they had permanently extended for C Corps, at least, that the tax rates will stay at that 21%. They don't revert back to the highest being at the 35%. For some business owners that are maybe an S Corp or sole practitioner, it might be worthy to look at and say, hey, if the laws are such that tax rates would go up for you, should you consider a different business structure? There's lots of things, but I think the big one, especially in a state like New York, is the state and local tax, the SALT deduction. And I think a lot of people's eyes are on that. Will that be eliminated or not?
Yeah, I think you always want to keep the focus on, there's always the businesses, which you'll hear a lot of people talking about the corporate tax, and that's very important for a
Right.
lot of reasons. But I think for the regular mom and pop or
Right.
retired couple or whoever we're talking to, you're looking at middle class, middle income people, and you want to know how is that going to affect them. And I think especially when you look at the typical maybe 65 years old-ish normal income
Right.
retired couple,
How
does it really affect
truly,
them?
Right.
And no politician wants to go after that person, right?
Right.
They want to go after the businesses, they want to go after the high income earners, but the average retired couple that is very good about showing up and voting
Yeah.
probably will not have they don't need to be in
Huge
fear,
change.
right?
No, not at all. And back to the headlines, right? In the media, you'll find them say 60% of taxpayers will end up having a higher tax rate if this sunsets. And it's marginal. You're talking about people paying like 0.5% more in taxes or
Sure.
something that is not notable. It's not going to impact them and their everyday lives, right? But
Right.
it's catchy.
Yeah, it's not to be too cynical. It gets clicks, right?
Right.
That's what the internet exists for, is to get clicks and
Yeah.
get attention.
We'll pay attention as professionals again to what happens with the estate tax exemptions. If those doubled during the Job Cut Act, there's certain things that will be impactful from a planning perspective as we
Right.
help clients. But again, it's too early to see what that's going to shake out.
Sure. And I think a lot of us, just on the New York State side, we talk about the exemptions for any kind of inheritance or estate plans. There's a lot to pay attention to, but it's not always on the federal side. Vote in your state elections too.
Yeah.
Your
Nice
plug for that.
plug. But I think longer term for us as financial planners, people are really concerned about the state of Social Security. I hear that a lot, especially if you're doing a plan for younger folks. It's like, should I count on that? Should I rely on that? Should you even put that in my plan? The state of Medicare, Medicaid, there's like certainly really big political decisions that eventually need to come to fruition about these things that our country has always foundationally had.
Yeah, and there's a lot of things that have been kicking the can down the road.
Oh,
We talk
yeah.
about Social Security too, which if you Google the Social Security, when it's going to run out, I think 9 years is the latest estimate. And that doesn't mean we get to $0 left in the fund. It means that 9 years from now, we're going to have less money
Yeah,
coming
going
in than is
in.
going out.
Yeah.
So 9 years from now, our politicians will have to address that, which means we have 2 more elections before they pretend to start to care about Social Security. It's a little cynical, but
Right.
what do you think
It's
changes
true.
there?
Right. Yeah. There's so many things, but I think you said it best, the kick the can down the road. It's such a big elephant in the room that I feel like everybody has kicked the can down the
Sure.
road, where when we're like, oh, there's $1 left in it, we'll decide to do something.
Yes, that's what it is. And kind of seen it play out before, right? We've seen the Social Security retirement age get bumped back.
Right.
The reality is of people living longer and with maybe less money being put into the system as a
Right.
big generation retires, there's going to have to be a conversation about either waiting longer to collect a benefit, collecting a reduced benefit, or somebody needs to pay more into the system. There's really only a few solutions, and there's not the magic wand solution of making everybody happy. Somebody is going to get less or somebody's going to pay
Right.
more, and that's just what it is.
I think to your point earlier, though, how we're not trying, or the government is not trying to hurt the average American citizen,
Mhm.
right? And that act really was to tax more on the wealthier side, right? They wanted that to be people $1 million plus in income or whatever are going to be paying more taxes. The same with Social Security. I always felt, why couldn't we, there's that wage threshold why couldn't we just tax up to a higher dollar amount to get more money in the system?
That's kind of what they've done. Gradually, they're raising the Social Security wage base over the years. That'll probably continue to go up. People that don't know what we're talking about, your Social Security is capped at a certain dollar amount. So once you earn over that, you no longer pay into the system. By either removing that cap or increasing
Right.
it significantly, you can get more money into the system, which some people don't love the tax the rich conversation, but
Right.
you have to take tax money from people that have money. So that might be a viable solution.
And I think, what was it, under Obama, where he said enough of the Social Security, file and suspend, and all those strategies if you were born after 1954. So there's been small changes along the way to make the system obviously more viable, but wait and see, right?
Yeah. wait
Like
and
you
see.
said, 2 more elections. We'll be
2 more elections.
here
So we
talking
got,
about
let's
it.
see, 2024, 2028, 2032. That'll be the big, write it down, put a note in your calendar. 2032, we'll be talking about that. Finally taking it serious as a country. This will be great for everybody. Perfect.
Absolutely.
So what are we missing from the election conversation? To summarize, let's say that you've got
Yeah.
somebody call you on November 7th, the day after the election, and say, hey, Ashley, I'm really upset that fill in the blank
So-and-so.
won. What am I going to do? I want to take all my money out of the stock market, or I want to do something. What is your response to that person?
I think the biggest thing really is having a plan, right? Just like roadmap to retirement, it's a roadmap that you have that's in writing where you're saying, I understand this client. I understand your income, your liabilities, your assets, your expenses. If this individual, this person, you're really backing into the appropriate risk tolerance, no matter what's happening in the world, whether it is a war or it's this person I don't like that's in office. And having that plan in place that tells our clients you will be okay despite anything that's happening in the world, that's key to me, right? Because it's stress testing those events when you're looking at the financial plan. We're running thousands of market scenarios saying the good, the bad, the ugly, this is the outcome.
Mm-hmm.
And that's what I go back to. This is unbiased, right? Is saying we put everything into this plan, we're factoring in taxes, inflation, and you're in a good spot.
But it feels so much more real in the moment, right? So when
Right.
you sit down and you propose a plan to a client, you say, based on the way you're investing, you may be just use really simple numbers, up or down 15% in any given year based on all these factors. And that's not perfect.
Right.
There's obviously many outliers to that. And a client might look at that and say, yeah, I can stomach being down 15%.
Right.
But then it actually happens.
Right.
And you get that
And
statement in the
we're having
mail.
to talk.
We're having to talk because you're seeing not only it's down 15%, but you're seeing that in terms of real dollars,
Right.
which can feel different when you look at your portfolio and it's I lost X amount instead of I lost 15%. And we have this habit as human beings of we're focused on the negative, right? We're loss adverse.
Mhm.
So when something bad happens, it's
Way worse than a gain.
It's way worse than a
It hurts
gain.
way worse.
yeah, we'd rather the joy that you get from gaining 15% is not equals the joy or the harm you get from losing 15%.
Right.
And we always have this gut feeling when it's happening of, but this time is different.
Oh, yeah.
It's
That's
just,
the
you don't understand.
favorite
This time
tagline.
is different. This election's different.
And it is always different, right? Because it
course.
is normally something that's different, that's a black swan type of event that, like, think of COVID. That's a great example where people were like, when's this going to end? We didn't know when there would be a vaccine. We didn't know when the market was going to turn around, but it did. And if you think back to that moment, the market was down a lot in 5 weeks, and then it just shot up from there.
Right.
So if you made a knee-jerk reaction and you abandoned your plan and what your advisor is telling you to do, and you sold the cash, when did you get back in?
Yeah.
You got to time it right twice, right? You're exiting before the bloodbath, and you're getting back in at the perfect time to catch it on the way out.
Yes.
We know that's impossible.
Yeah.
We know market timing doesn't work. And I mean, again, in the moment, it's hard to say to somebody, don't stay the course, but time and time again, that's proven to be what's made the most sense is to stick
Yeah.
to your long-term goals.
There's a statistic or a study out there that I'm going to do my best on. I'll probably get it wrong in the moment. So if anyone's listening to this and it's wrong, I'm sorry. But JP Morgan did a study on comparing the market returns to the average investor.
Oh,
And what
yeah.
they found is that the market returns, I think they used the S&P, was like 9 or 10% historically going back maybe 20 years. And then the average investor got 2.3% or
Yep.
something. And what's the difference between the market returns and the average investor?
They're getting in and out of the market,
They're
right?
trying to time the market.
Human
They think-
error,
Yeah, exactly. They think they know things that they can't possibly know,
right?
which is a huge mistake.
And even as professionals, like you're probably like myself, where I'm nearly 100% in stock. So when the market goes down and quickly, it's easy to go, maybe this time is different. Maybe I should sell out.
Yeah.
And we know better. And luckily, if you just don't look at the computer, don't read the headlines, put your statements away, just don't think about it. By the time you go back to it to say, oh gosh, I hope things have gotten better, it probably has.
Yes.
So,
Turn the news off. Go hug your kids.
right. Go take a walk in nature,
Yeah. The
throw
other
a snowball.
Yeah, sure. Have some fun. The other story I'll squeeze in, we talked about this a little bit before we started recording, is I've had several people, and I'm thinking of a couple people in particular, but maybe before the 2016 election, they really didn't like Donald Trump. Then he won, and they said, I'm going to pull everything and put it in cash.
Oh, yeah.
And
I had
some of
lots
these
of those
people,
too.
I'm sure you can think of a few people, but they're still sitting out there and they're still in cash
Mhm.
8 years later. And if you look at pretty much any investment they could have possibly been in,
Right.
pick your worst performing mutual fund. I don't know. I guess I should look this up before I say it, but pick like an average returning mutual
I'm
fund
going to agree with you here.
and you
Would have done
absolutely
better.
beat cash, right?
Absolutely.
So it's
Absolutely.
get the
Yeah.
political stuff out of it.
Again, we can look at all these statistics and charts and whatnot, but if you look at over a 100-year period and you look at what cash has done versus inflation versus bonds versus stocks, we certainly know a diversified portfolio that includes stocks and bonds and some cash is going to outperform over the medium to long term than sitting in cash.
Absolutely. So we spent most of this episode talking about basically the idea of don't do anything. It's
Right.
the theme here, right? Like, what should I do
Absolutely.
differently? You shouldn't do anything differently, but you should still be doing some things intelligently, and that's being in the right portfolio for you.
Right.
So what are some things that we can think about that are things that people can be doing to evaluate whether or not they're in the right portfolio initially? We don't want to wait until we're down 15% to be
Right.
like, oh no, I'm in the wrong portfolio. So right now, if you're looking at it and you want to say, is this a portfolio that I should stick with for the next 5, 10 plus years? What are the signs of that?
I know I'm going to sound like a broken record, but I really
Perfect.
think going back to the financial plan, right? Looking at when do you need the money? That's a huge piece, because if you have somebody that's retiring this year or next, and they're entering their first year of really being a little bit uncertain of what expenses are going to look like, you might say you have been really aggressive because you've been working, you've been shuffling money into accounts versus spending them. I think it's huge to know the time horizon for something. Can you wait it out? And then the risk tolerance piece, I think the longer you get to work with your financial planner, the more we're going to know them, right?
Sure.
And definitely, I was in California advising during the Trump election. And so I had a lot of people want to sell to cash, and it wouldn't have played out well. But those same people were calling me with every little dip in the market. And so for me, that was a gut check to say, we probably do need to reduce your risk.
Sure.
Just knowing that anytime there's a headline news article that's coming out, you're panicked. Just take some risk off the table. You need to be able to sleep at night, right?
Everyone's a risk taker. Everyone is a risk taker in a bull market, and then it starts to go the other way, and they're not so much. So it's a hard conversation. I think one thing that we found really helpful with clients that are maybe risk adverse, or just people that are in retirement in general, when they're starting to look at their portfolio as money they need today versus when they were working, it was just a far down the road type of thing, is we like to use the bucket approach, which we definitely didn't invent, and you know what I'm talking about.
Yeah.
But if we can take X amount of dollars from your total portfolio and set it aside in this short-term bucket, and this is the money we're going to use for the next 5 years, we'll call it, and we know that we have 5 years of income sitting in this bucket, it makes it a lot easier to sleep at night when the long-term bucket is going up, down, left, center, because you know that you've got the money you need to spend the next 5 years. And as long as the market recovers in the next 5 years, which it might,
historically
should.
Even after 08, it did, yes.
Even after 2008, it did. You can feel a lot more comfortable with that. And even if it just means getting two separate statements in the mail, and one is your short-term bucket, and one's your long-term bucket, you can even label it that way if you want to. When your long-term bucket's down that 15%, you can sleep at night knowing you're not touching that money for 5 years.
Yeah, and I love that, because that requires you to think about your expenses and what your actual needs to back into that 5-year number for that bucket. It is doing the hard work to say, what are my needs? And also, what's my pain threshold for that longer term bucket? Is it 15%, 20, 25, or is it 10?
And I think you mentioned the word needs. I think that's a good reminder to tie your assets to an actual purpose. It's not just money for having money's sake, right? We don't just want to grow our wealth. Well, we do, but we don't want to just grow our wealth forever with no reason. We're growing our wealth for a specific purpose. So if this money is funding the next 5 years, this money is funding a fun trip with our grandkids down the road, whatever it is, tie some meaning to it. And I think it'll change the way that you start to invest.
Yeah, absolutely. I agree.
Something to think about.
So moral of the story, don't make any knee-jerk reaction changes.
Yes.
No matter who ends up in office in a month from now.
So our lessons for today are no knee-jerk reactions.
Revisit your financial plan or get together.
Consider the financial plan. Yep. We want to make sure that's at the forefront of everything we do. Tie meaning to your money. What else are we missing in there? Don't watch the news. Okay. I've said
Delete
that twice.
social media. No.
Delete social media. Do that. Except for listen to our podcast, obviously.
I'm like, but yeah, this will probably go on one of those channels.
It will. Cool. We are getting to the end of our time here. Is there anything else that you want to make sure we cover today?
No, I think that was awesome. Thanks for having me.
Absolutely. Thank you for being here. Glad we could do this. And there's no good way to end a podcast, so we're just going to cut it off. All right.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.